What if I told you it's possible to collect $12,000 a month in retirement, $144,000 a year, and potentially reduce your federal income tax significantly, and in some cases even to zero, depending on your structure? And I'm not talking about cheating the system, not by hiding money in offshore accounts, but by using the same tax code that the IRS publishes every single year. Most retirees never learn this strategy because our advisors are so focused on growing assets, not on tax-efficient distribution. But if you're sitting on $500,000 up to $5 million and you're wondering how to turn that into reliable income without having to hand 1/3 of it off to Uncle Sam, this video is for you. I'm Mark Wisniewski, president of Southern Incomes. I specialize in helping pre-retirees and retirees build tax-smart income plans that last. And today, I'm going to walk you through exactly how some of my clients structure their retirement income to live on that $12,000 a month while staying in the 0% federal tax bracket. If you find this helpful, hit that like button and subscribe. Here's what we're going to cover. First, the math behind zero federal tax and why most people miss the $131,000 opportunity just hiding in plain sight. Second, the 3-bucket system that makes this all possible and why having all of your money in a 401k kills this strategy. And third, the 2 stealth taxes that can destroy your plan even when you're paying zero federal income tax and how you can avoid them. Now, let me be clear right up front. This strategy is not for everyone. It's going to require planning, the right mix of accounts, and it won't work if all of your money is locked up in traditional 401ks or IRAs and stays there. But if you've been intentional about how you saved, or if you're willing to do some strategic repositioning before you retire, this can be possible with the right structure and planning. To pay zero federal income tax, you need to stay really under 2 certain thresholds. First, your taxable income. That's going to be your income after deductions. It needs to be low enough that you owe no regular income tax. So for married couples filing jointly in 2026, the standard deduction is $32,200. What does that mean? Well, the first $32,200 that you pull from taxable sources is automatically tax-free. Second, if you're generating income from long-term capital gains or qualified dividends, you could take advantage of the 0% capital gains bracket. So for married couples in 2026, that bracket goes up to $98,900 in taxable income. So between the standard deduction and the 0% capital gains rate, using current thresholds for illustration, you may have room to pull up to roughly $131,100 a year without triggering any federal income tax. Add in truly tax-free sources like Roth distributions, municipal bond interest, whole life policies, you can hit $12,000 a month or even more without touching the federal income tax brackets. Now, individual tax outcomes vary and thresholds, they change over time. So this example is for educational purposes only. Here's where most people get tripped up. If 100% of your money is in a traditional IRA or 401k, every dollar you withdraw is going to be taxable as ordinary income. So you're starting from behind. So to execute this strategy, you need money in 3 buckets. Bucket 1 is those tax-deferred accounts. That is, those 401k and your IRA accounts. Use those sparingly or not even at all, or not at all, depending on your other sources. Bucket 2, taxable brokerage accounts. These hold stocks, bonds, ETFs, mutual funds. When you sell assets that you've held for more than 1 year, you're going to trigger long-term capital gains, which can be taxed at 0% if you're strategic. Bucket 3, tax-free accounts, Roth IRAs, Roth 401ks, and health savings accounts too. Qualified Roth distributions are completely tax-free. HSA distributions used for medical expenses are also tax-free. In retirement, healthcare is certainly one of your biggest costs, so an HSA can cover thousands of dollars a month in your Medicare premiums, your prescriptions, and other out-of-pocket expenses without generating any tax bill. If you don't have money in all three of these buckets, you may want to start repositioning now before you retire. What does it mean? Well, it means doing those partial Roth conversions in low-income years, funding a Roth IRA if you're still eligible, or maxing out an HSA if you're on a high-deductible healthcare plan. So let's say you need that $12,000 a month. That's that $144,000 over the course of the year. Here's one way you might structure it. Start with your Roth IRA. Let's say you pull $40,000 a year from Roth accounts. That's completely tax-free. No income reported. No effect on your Social Security taxation or your Medicare premiums. Next, I'd say tap your taxable brokerage accounts. So you sell appreciated stocks or funds and you generate another $60,000 in long-term capital gains. Your cost basis, now that's what you originally paid for those investments, might be, we'll say $30,000. So only $30,000 is an actual gain. But here's the key. If your taxable income is low enough, that gain is taxed at 0%. You pocket the full $60,000. Next, I'd say use your HSA to cover medical expenses. Maybe you're spending $15,000 a year on your Medicare premiums, your prescriptions, and just all of your doctor visits. So you reimburse yourself from your HSA. That's tax-free. Finally, if you have municipal bonds in your brokerage account, the interest that they generate is federally tax-free. Let's say that, it throws off another $10,000 a year. Add it up. $40,000 from the Roth, $60,000 from capital gains, $15,000 from that HSA, and $10,000 from munis. That's $125,000. And you're still under the threshold. And you haven't paid one single dollar in federal income tax. But wait, there's more. You might pull another $19,000 from a taxable source and use the standard deduction to cover that. Now you're at $144,000. That $12,000 a month and your federal tax bill is still zero. Now, here's where people make mistakes. Even if you're paying zero federal income tax, you could still get hit by what I call stealth taxes. The first is the taxation of Social Security benefits. If your combined income, which includes one half of your Social Security plus other income, if that exceeds certain thresholds, up to 85% of your Social Security is going to become taxable. So for married couples in 2026, that threshold is $44,000. So if you're pulling $144,000 from other sources and collecting Social Security, you might push yourself into a higher tax situation that you did not plan for. The second stealth tax is IRMAA, Income-Related Monthly Adjustment Amount. That's the Medicare premium surcharge. If your modified adjusted gross income exceeds certain levels, you're going to pay more for your Medicare Part B and for Part D. For 2026, that kicks in at $218,000 for married couples. So even though you're not paying income tax, you might be paying an extra couple $100 a month in your Medicare premiums. What's the point of all this? The point is zero federal income tax does not mean zero tax consequences. If you've got to think about the whole picture. Now, if you're watching this and you're thinking, whew, that sounds complicated. How do I even know I'm setting this up right? You're not alone. This is exactly why we help clients at Southern Incomes build tax-efficient income strategies that actually work in the real world, not just on paper. If you like help structuring a plan like this for your situation, I've got a link in the description box below to book a time with me. Now, here's one more thing that you need to know. If you've got money in traditional IRAs or 401ks, at age 73, you're going to be forced to start taking required minimum distributions. And those RMDs are taxable as ordinary income, and they can just blow up your zero tax strategy if you're not careful. That's why I tell clients, if you want to live tax-free in your 70s and 80s and beyond, you've got to deal with those IRAs in your 60s. Do Roth conversions in years between retirement and RMDs when your income is low and your tax bracket is completely manageable. Move money out of tax-deferred buckets into tax-free buckets. Yes, I know you're going to pay taxes on the conversion, but you're paying at a lower rate now and you're setting yourself up for tax-free income later on. Now let me address something. I'm not anti-tax. Taxes, when used right, make this country work. What I am against is retirees paying more tax than they have to because they did not plan ahead. The tax code rewards people who think strategically about when and how they pull income. If you spent 30 or 40 years building your wealth, you certainly owe it to yourself to build a distribution plan that's just as smart as your accumulation plan was while you were working. So here's the bottom line. Retiring on $12,000 a month with zero federal income tax is possible, but it's certainly not automatic. It requires the right mix of those accounts, a tax-efficient withdrawal strategy, and planning that starts before you retire. Between the standard deduction, the 0% capital gains bracket, those Roth distributions, HSAs, and municipal bonds, you can create a six-figure retirement income without ever writing a check to the IRS. But you have to avoid those stealth taxes, Social Security taxation and IRMAA. And you have to plan for RMDs before they wreck your entire strategy. If you've got assets, but you're not sure how to put all the pieces together, that's exactly what I do. I help retirees and pre-retirees build income plans that are tax smart, sustainable, and built for the long haul. And if you'd like personalized help building your plan, book a time with me. Link is in the description below. Thanks for watching, and I'll see you in the next one.